Welcome, everyone. I hope you and your family are keeping safe and healthy. Thank you so much for joining in for the 3-day Algo Trading Basics workshop, and we are thoroughly humbled to see thousands of you joining in for the same. My name is Pawan, and I'll be your host for today. The aim of the workshop is to educate trading enthusiasts about the dynamics of the algo trading industry, and we are sure that at the end of day 3, you will have a lot more about the domain than you currently have. So make sure you stick around until the end. Just in case if you happen to drop off midway, please use the YouTube broadcast link that we have shared with you on your email and chat. As we are at peak capacity, there is a chance that you might not be able to join back in. I would love to have the pleasure to pass the stage now to today's speaker, Mr. Vivek Krishnamurthy, and I hope you all have a wonderful learning experience. Over to you, Vivek.
Great. Thank you so much for that introduction, Pawan. Hello, folks. I'm very happy to and excited to meet with you guys online for the very first day of the Algo Trading Workshop that we have. So we are calling it the big picture because as we go over the 3 days, we are going to concentrate on different areas of this very interesting and deep domain. Right. So as I usually begin any kind of presentation, I'd like to first lay out the agenda for the day. So at the beginning, I'm going to talk a little bit about us as the organization. To give you a short background about myself. And then I'm going to do something which is slightly unusual, which is I'm going to give you the climax of this entire 3-day event that we're having. Because I want you to know what you're going to have at the very end. Then a short description of what we have planned for today, tomorrow, and the day after. And then we really move on to the agenda for today's presentation. So I start off with what is algorithmic or quantitative trading, and then move on to where we try and understand this trading and investing landscape as things stand in 2021, the pros and cons of quant trading, what are the various steps that we take in order to build a quant trading strategy. I talk about the difference between the classical or the traditional approach to investing and trading compared to a quant approach. There are similarities as well as places where they diverge. I'll then retouch upon some of the benefits because I think you might view it in a slightly different light once you are able to see how the differences lie between the traditional and the quant approach. I'll also touch upon the different types of data that comes into play when we want to design quantitative trading strategies. What are the things we can do to get familiar with the domain? Some final words, and then I'll point you to some resources where you can continue the learning, not just for today or tomorrow, but I would argue you can continue it lifelong because this is it's a kind of domain which is literally like the Pacific Ocean or the Atlantic Ocean. It's deep and it's wide, and we all are continuously learning day after day as the more time we spend in it. And to round it all off, I'll also talk about what's in store for tomorrow, and then I'll leave the session open for some questions and answers that we have. So when it comes to talking about us, the organization, we are QuantInsti, and we are the research and training arm of IRH Capital. IRH Capital is one of the largest high-frequency trading firms in India. We are market makers for many Indian F&O contracts. And like I mentioned, QuantInsti is the research and training arm of IRH. QuantInsti itself has a suite of products, primarily 3 of them. So one of them is the EPAT, which is our flagship program that runs over 6 months. It's got lectures that are scheduled over the weekends. So you have about 40 odd lectures happening on 3 hours on Saturday, 3 hours on Sunday. And that runs, like I said, for about 6 months, where we cover the domain literally in a lot of depth. So there's obviously there are the lectures, there's a lot of pre-reading, assignments, quizzes, and so on. in order to make sure that participants have this pretty intense and immersive experience. And at the end of it all, they feel confident enough to get on to, dipping their feet themselves into quant trading or working in the domain in organizations that need skills of that sort. We also have a suite of products called Quantra, which are self-paced courses. So as opposed to EPAT, which is instructor-led, Quantra is shorter in length. So you have courses that range from 2 to about 15 hours in length. We have a mix of both free as well as paid courses. So I would encourage you to go and take a look at all the courses which caters to people at the beginning of their journey as well as at the intermediate level, as well as at the expert level. And the third product that we have is Blueshift, which is really a backtesting, research, and a trading platform, which makes it easy for us to trade systematically. So it's essentially designed for people who want to migrate from the standard or the conventional mode of trading to something which is more quantitative or systematic or algorithmically oriented, right? So that's a little bit about us. As I've mentioned before, my name is Vivek Krishnamurthy, and I guess I would call myself a researcher and an educator of the quant finance domain. So by trade, I am a researcher and instructor or educator. I head the research and content team at QuantInsti. I come with experience in both industry and academia across various places in India, Singapore, and Canada. I've co-authored 2 books. Both these books were written in my stint while I was part of QuantInsti, this organization. So one is a book which is targeted at people who want to learn Python specifically in order to use it in the financial markets. And the second book, which is a slightly smaller one, is like a guide to the domain where you get a sense of what the domain is about, what are the various fields that it encompasses, how you can actually find a way to enter the domain, both as a hobbyist trader, or as a person who wants to enter the job market specifically in the. By way of qualifications, I played the engineering MBA about 10, 15 years ago. It was, I guess, the flavor of the season back then. Doing an engineering degree and then following it up with an MBA, and that's what I did. All right. So as I promised you guys before, I'm going to jump straight into the climax of what we are getting at. So at the end of these 3 days, that's the day after tomorrow, what we hope you will get to is you will learn to backtest a quant trading strategy on historical data and multiple assets. Even if you don't know much programming, or in fact you have literally no exposure to programming, you'll learn to analyze its performance, how this particular strategy will work on historical data, and you'll also learn how to take it live based on its past performance. So obviously, when I say based on past performance, if you're trying some strategy out and it's not doing very well, you anyways would not want to take it live. If it's doing well in your testing, that's when you will even consider the possibility or the option of taking it. That's what I mean by that. And while we do that, I also want to show you maybe a screenshot or a screen of what's going to happen on the last day. So I'm right now on the Blueshift portal. Let me log in first. And all right, so I'm not going to actually walk us through any of this because this is going to be covered at length by the time we reach day 3. This is more like a teaser for you to understand how this thing sort of works in terms of understanding how a strategy would have operated if we had run it for about 5 years, let's say from the 1st of Jan 2015 till say the 31st of December. So here we are running a strategy on the NYSE stocks. And let's just look at the output of a typical back test, all right? Okay. So what you see on your screen here are the results of a back test run on the NYSE data for about 5 years, like I mentioned, for other 6 years, like I mentioned, from the start of 2015 till the end of 2020. So we can compute that we're getting a return of about 350%. We have something called an alpha and a beta and a Sharpe ratio and a drawdown. I'm not going to get into any of that. But nevertheless, what I want you to notice here is you have a plot where you created a portfolio based on some strategy that you're going to see a couple of days hence. And you're seeing how this particular strategy performed with respect to the benchmark. So the benchmark in this case would be something like the S&P 500. But like I said, I'm going to leave that for later. But this is what we hope to have you get to by the time we end this workshop over the next weeks, right? All right. So now that I've given you the spoilers, let's now get on to the actual story. Right. So the 3-day plan with respect to whatever we are doing is first, like I said, is the big picture. So what I'm going to try and do today is I'm going to try and give you a feel for the domain, help you understand the difference in quant and manual trading and how strategies are developed. This is for like a 10,000 feet view of the domain. Day 2, we're going to move from 10,000 feet maybe down to about 1,000 feet. So we are much closer now to the data. So you learn more about strategy workflows, how you're going to fetch data, what are the sources, and how you will be able to formulate and practice the strategy in Python. And day 3 is where you're right there, where now you're going to take all the stuff that you learned on day 2 and start applying it on a research and live trading environment. So, which is what I just showed you. The last shot that I showed you in the application of Blue Shift is what you're going to see on day 3, right? So it's going to be a hands-on session. So those of you that would want to work along with the instructor, I would encourage you to go and create an account on Blue Shift, so that when that session goes on, you can actually run it along with what the instructor tells you. The instructor would be my friend and dear colleague Jay, who will be doing that on day 3, right? Okay, so now we are moving on to the actual meat of today's session. So let's start off with the very first question. What is algorithmic or quant trading? If you actually go and do a web search, or in fact, if you go and do a web search in different countries as to how it's defined, you'll be surprised to find that each regulator has slight differences in the way they interpret this term. So SEBI, who is the regulator for the financial markets in India, says that algorithmic trading is whenever you have some sort of automation in the execution of the trades that you want to do. That's called algorithmic trading. So however you generate the orders, even if you arrive at deciding to buy or sell manually, if the execution part is via some degree of automation, it's algorithmic trading. Now, MiFID, which is the regulator for the European Union, has a slightly different way they define it. I don't want to get into the specifics of each definition, but suffice to say that the definition of SEBI is slightly different from MiFID, which is slightly different from the FCA, which is the UK regulator, which is slightly different from FINRA, which is the US regulator. So really, it's an unsettled question as far as regulators. However, I think to make things simple, what we can think of when we talk about algorithmic trading is, it is essentially the use of computer programs to trade financial assets in a predetermined or a premeditated manner. And I think the operative word here is premeditated. which means that the trading strategies that we are thinking of or designing or building have to be tested prior to the actual trading happening. Meaning that the trades that take place have all been pre-decided on a set based on a set of rules, right? So these rules that you set uh, are used based on the style of trader, are used sometimes to calculate the price at which you want to trade or the timing at which you want to trade. So some people have a preference to trade right when markets open. So they might set up a program which wants to trade in the first 15 minutes when the markets open. There could be others who want to trade in the last half an hour when the markets are going to close, and a myriad other characteristics. So you set up these rules, and the orders themselves can be placed in different ways. So you have, I would say, semi-automatic ways in which these orders are placed, and there are even fully automatic ways. So when I say semi-automatic, you have cases where the final authorization for the order getting placed with your broker has to be with a click from your end. So you need to eventually click on submit or trade or some such, right? So yeah, this is essentially I would say a simple or a pretty decent working definition for algorithmic trading. Now, even as far as the term itself goes, it's I would say it's like a suitcase or a catch-all term, right? It encompasses many different things, and you can look at it in different ways. So I've actually just thrown three different words, which all often get combined with the term algorithmic trading. So, for instance, if you look at systematic trading is where you come up with a set of rules in order to trade. So, you could set these rules with regard to, let's say, how you allocate your capital, or certain risk measures, or certain other goals, and you just follow those rules strictly, no matter what happens to the market. So, for instance, if you come up with a set of rules that I want to invest in the top two firms by based on the performance yesterday. So, based on yesterday's performance, whichever stocks gave the highest daily return in each sector. You look at the stocks that gave the highest return in each sector. So you pick up say 5 sectors and you decide to go long on 5 of those stocks. You decide that you want to allocate exactly 20% of your capital on those top five firms, and you define those top 5 firms based on their return yesterday. You are going to follow through on that trade regardless of what happens when the market goes, right? So the state of the market is not going to determine what you do. You just follow your rules, and you can even place those trades manually. So even that, I would say, falls under the ambit of something like systematic trading. Automated trading is, you can think of it as a combination of say systematic and adding a little bit of programming or some degree of automation to whatever process you decide. So let's say you decide on certain trading rules again, similar to what I just said for systematic, but this time you programmatically express yourself. So you are not going to manually check when markets open or what happened the previous day. Your program is going to sift through hundreds or thousands of stocks in order to identify those stocks that you want to move long on, and then you just let them run in the live market. And you have quantitative trading, where you use a little more sophisticated techniques. You use statistical modeling on market data to arrive at certain trading rules, and you follow them again in the live market. Now, however you call it, whatever you call it, whether it's one or the other or a combination, the one thing that's common to all of these is you have a set of rules and you want to apply those rules in markets without second guessing what's actually what should be done, irrespective of how the markets are behaving. So if you set a certain set of rules, you're just going to let your strategy run without sort of meddling in how it actually runs. Right? So that's algorithmic trading. Hopefully that should give you a sense of what we are talking about. Like I've mentioned a few times now, it's primarily rule-based, and you have programs that help you instantiate or express those rules, right? So the next thing I want to talk about is the the current trading and investing landscape that we live in. So, in fact, many of the things that are written on this slide are applicable to, I would say, industries across sectors. I mean, it's not just the financial markets that are influenced by this. So, when I say markets are increasingly dominated by algorithms, it's literally the world or the economies around the world are increasingly being dominated by it. So, whether it's how we shop, how we date, who we marry, what we trade in, all of these things have some sort of machine learning algorithm that is sitting below all of that. So whether you're using an Amazon to buy your groceries or electronic goods, or whether you're using a Tinder or any of these dating apps to find a potential partner, or you talk about buying books, all of these things are constantly trying to aggregate data that is accessible and bring it all together before in order to produce the kind of options that you. In the very same way, the financial and investment markets are also increasingly dominated by algorithms. You have a lot of computers that are essentially chewing and ingesting all of this data that is getting generated and trying to get a sense of which direction prices are moving and trying to spot these pricing anomalies. Now, why do we see this kind of thing? Well, I think it's a combination of multiple things. So you have, on one hand, you have cheap computing that's become ubiquitous everywhere. Most of the phones that we carry around in our pockets cost, barely a couple of $100 or less, but they are extremely powerful machines with regard to their processing capacity, their storage capacity, as well as the RAM that they have. You have reliable and fairly cheap internet connections everywhere. You have the storage revolution where things are cheap. And if all of that is not enough, you also have cloud infrastructure these days. So there are even getting access to cloud servers for the average guy on the street has also become much more affordable. So because of all of these factors together, industry and the finance industry has moved towards automation and trying to find a way to use all of this data to sharpen the way we trade and invest. And it's become pretty common across major market players as well as retail traders these days. So anywhere you look, wherever you look, you find that you have people who are trying to skill themselves with regard to learning to process and work with data, right, and analyze it better than they could. Like, so I've come across this chart a few years back on Financial Times, which clearly shows you how if you look at the share of quants and high frequency trading, it's quite clearly for over 10 years now, more than half of US equity trading is now dominated or it's accounted for by quants and the high frequency trading firms out there. Right? So, and this is common, not just, this is something you see not just in the States, you see it across the world in emerging markets as well as other places like the UK or the European Union or Singapore, Hong Kong, India, and China and other places too. Right? So there's a steady increase, as you can see. Even if you look at the quants part, you can see a steady increase over the last 10 years. If you cast your eye across various news platforms, whether it's business news or even television news, you find that there's this emphasis now on specifically even people in the finance domain learning to program and learning to code. Right? Again, cast your eye at job bulletin boards anywhere, literally any country, and you'll find that there's literally a prerequisite these days, or one of the nice to have skills is for people to know how to program. Right? So names like Python and R have become so commonplace in job bulletin boards, so that people are able to perform a certain degree of data analysis in these high level languages. And as I mentioned before, the reason you need this level of data analysis skills is because of the crazy amount of data that's even getting created, which is getting created because of the other things like computing power and cheap storage and other things that I mentioned. Right? Even in the post-COVID world, actually, I'm not even sure whether to call it post-COVID because we still seem to be in the midst of it. Let's just call it the COVID-19 world. Things haven't really changed. So, whether it's the rise of algos when it comes to stock markets, and when you talk about the hiring that's happening, uh, news articles that you come across, you keep hearing these buzzwords like machine learning and artificial intelligence. I just pulled while I was creating the slide deck for this session, I came across this article in the Times of India, which just a couple of days back, where JP Morgan is hiring 4,000 techies in their Indian units, specifically in the domain of artificial intelligence. Machine learning. So, all of this is essentially pointing to the fact that a basic level of data analysis skills via a programming language is soon, if not already, becoming the equivalent of knowing to use the Office suite of applications of maybe 30 years back. Back maybe in the 80s or the 90s, even knowing to use a Word or a PowerPoint or an Excel would be good enough for people to put it on their resumes. Right? Or maybe 50, 60 years back, the premium that was attached to typing, right, to be able to type, is what's happening really with respect to programming and data analysis. All right, so that I think should give us a sense of the domain and the kind of landscape that we inhabit with respect to investing and trading. Let me now talk about both the pros and cons of quant trading. Right? So you have a bunch of pros. So let me start with the very first one, which is speed. Right? Now, the moment you start automating stuff, you are not limited by the limits of our own human brains. Right? However smart I may be, or however smart a trader may be, I'm still limited by that the 6 inches of stuff I have between my ears. Right? There's a certain constraint there, and because now we are not limited by that, we can even start thinking of strategies that operate at a frequency which is higher than what we can scan. Right? So it's like a whole new world opens up in front of you for the simple reason that you have a computer to help you do a lot of the data processing. So, for instance, scanning hundreds of assets while wanting to make certain trades is even possible because of a certain degree of automation. And so you don't have to restrict your pool to, let's say, I'm going to only look at 50 assets and pick, say, the best 10 today to trade. Right? So you don't need to be the monkey behind the monitor who's clacking away at the keyboard. You can create a certain level of automation which does a lot of the heavy lifting for you. So that's about speed. So when I talk about efficiency, with this level of automation, what happens is now you don't need people to keep staring at screens, watching how prices fluctuate, or watching the flow of news and how that is impacting prices. So because you don't need individuals standing in front of monitors all day, their time can be better utilized by where they can spend their time researching and trying to test new strategies now, and which can come together to create a pipeline of strategies, of profitable strategies, which can be deployed at different stages. Right? So there's a more efficient utilization of the humans in the trading setup. Right? With regard to scalability and uptime, the fact that again you have a high degree of automation means that you don't need to stop the trading just because you're going for lunch or to the loo or to get a smoke. You can continue to run your strategies on multiple instruments across multiple markets at the same time without really any interruption. Another often cited benefit of any kind of automation of quant trading is that you can trade minus the emotion. The reality is we are emotional creatures as human beings. So the moment we decide to try and keep the emotions out, what we really want to do is we want to make sure we do some thorough testing of a particular strategy. Once we are comfortable that this should, and we are reasonably confident it should work, we just deploy it and we let it run. Right? We try our best not to get too excited or too dismayed at the movements of the markets and try and override what the strategy is set out to do. So we don't want to override or we don't want to interfere in the way the strategy is actually taking positions. Uh, the reality is that it's unlikely that these kind of interference or manual interventions is going to improve your strategy performance. So you just let it run and you so that kind of takes care of not getting swayed by the typical sentiments of greed or fear that we are all caught up in when markets are very volatile. Now, I don't mean to say that there's no degree of human judgment. Of course, you need to exercise some judgment when it comes to deciding to say retire a particular strategy. Right? There are times when you realize that this strategy is not performing anymore. But that still does not mean we interfere with individual trades at a strategy. So we just retire a strategy altogether rather than selectively choosing when we want it to run and when we so that essentially talks about trading minus the emotions. I think the single or one of the most important benefits of quant trading is what is called backtesting. In fact, we'll end up spending quite a bit of time doing this. So backtesting essentially is imagining that we were running this strategy 10 years back or 5 years back or 20 years back and seeing how it would perform if we had actually done that, right? Now, of course, the I would say the implicit assumption here is that if something worked on historical data, that should hopefully tell us something about what's going to happen on the unseen data or the future, which is not seen or not known, right? And obviously, thanks to millions of such tests done, we know that we can be pretty confident that something that worked on historical data, making sure we ran it well and we accounted for different kind of biases, it should give us a pretty good. We should have pretty high odds that it should perform even in live unseen markets, right? So I think it's an important tool or an important benefit of any kind of automation of quant trading approach that we take. And the last but not the least is the kind of metrics that we use when we want to analyze how our strategy has performed, even in backtests or in actual markets. Now, typically with manual or classical style of trading, discretionary trading, we would look at the P&L. We would look at what happened to our trades, how much money we made, etc. But what the quant approach or the automated approach does is and this also has a lot to do with the ecosystem that's developed around it with regard to all these tools and libraries that you have. It helps you keep track of a dozen different statistical metrics that give you a much richer picture on what's actually going on with your portfolio. So you can track things like leverage and drawdown and monthly performance and ratios and equity curves and what have you. Right? So I think you have a more complete and a richer picture with regard to what it is that you're doing, and which helps you also take better decisions with regard to trade. Right? So that's with respect to the pros. Some of the cons, which is also a reality of this domain, is that the capital requirements are generally higher. So your brokers are likely to. So if you want a connection which allows you to automate stuff, then you need to keep a certain amount of money in your brokerage account. So the capital required is higher. Often, if you're looking for some sort of data feed that, again, your program or your algorithm can directly ingest, that often comes at an additional cost. So that's the capital. There are also infrastructure costs. So you need you need a computer of a certain level of performance. You need, of course, reliable internet connectivity. Depending on where you live, you need to make sure that you have power backup. These days, even cloud infrastructure, because people prefer to have most of their stuff on the cloud. They want to reduce the dependence on their local workstations. So cloud infrastructure can be an additional overhead. The good thing is that these days, in fact, not just these days, for many years now, these costs have been dropping quite rapidly. I mean, so you have things like Moore's law, where literally processing power reduces by nearly half every few years or so. You have affordable private servers these days on the cloud. You have things like the Amazon Web Services or Microsoft Azure or several other cloud computing tools that are available, and they become very accessible to anyone who even has an internet connection. Right? And the third and also important factor is the skill gap. Right? So before you actually delve into the domain, you have to be reasonably comfortable with programming, statistics, and math. I don't expect any of us to be PhDs in even one of these fields, but you need to have a decent grip on these topics. And that doesn't come easy. It takes time, it takes effort, and it takes some amount of mentorship to build them. And this is can be an entry barrier when you want to get into the domain. You have, of course, research and trading platforms like Blueshift and Quant Connect also, which help alleviate some of the technical overheads that you face. Where it tries to take out some of the harder aspects of any kind of analysis you do, but nevertheless, you still need a certain degree of comfort with the domain for you to even use these kind of platforms that are available out there, right? So that's as far as the cons. Now let me talk a little bit about what are the steps that you need to build a quant trading strategy. Now, this is, of course, your first glance at these steps. You're going to see it again tomorrow as well as the day after that. However, like I mentioned before, today is the 10,000 feet view of how it starts. So it all starts with an idea that you might have. This idea could come literally from anywhere. It could be from past experience. You might have burnt your fingers, or maybe from a friend or someone you know. It could come from some preliminary data analysis you do. It could come from some academic research paper that you came across, or it could be just a hunch based on what you see in the news. So that is where your idea sort of germinates. You think about, so the idea kind of tells you what is it that you want to trade in, why you want to trade in, and then you decide on when you want to buy or sell what you're doing. You decide the entry and exit conditions for each trade. The next part is, once you've come up with those rules, you want to express it or encode it in a suitable programming language, whether it's a Python or an R or a MATLAB. So these days, even if you cannot program, there are tools and functionalities these days that you find that are integrated within trading platforms that help you paper over some of these challenges that you face. Once you do that, you want to now test out this idea, this hunch that you had on the historical data and validate and see if there's any merit to this strategy. You measure and closely monitor how it would perform based on, like I mentioned before, many different metrics, whether it's something as simple as a dollar P&L, or whether it's number of profitable trades or several other ratios. In case it passes through all of these filters, and by the way, it maybe 1 in 5 or 1 in 10 are going to pass through all of these filters. The next thing you want to do is you want to paper trade. So now that you have these filter strategies, you want to run it on real market data. And bear in mind, when I say paper trade, you're not putting in real money here. You just want to imagine that you're trading it. So you can do it via demo accounts on some brokerage portals or elsewhere. So you have simulators. So you're not actually buying or selling, but you're just letting it loose in, I would say, this simulated or a demo environment. And based on how it performs in the paper trading setup, you then push it onto the live markets. where you let the strategy do its job. Once you push it there, of course you still want to monitor the performance and you want to make sure that you're managing risks and so on. So a quant trading strategy doesn't mean you can automate everything, let it all run, and then spend the whole week at the beach, sipping beer and enjoying the sun. You still need to be around your terminal. You still need to do these other things that I spoke about, which is researching and trying to find more strategies to build a pipeline. But by and large, I would just imagine, I would think of this as a better utilization of your time with regard to what you do, right? If we compare, the traditional approach versus the quant approach, the traditional approach is usually you start off with the trading idea, so that's common. You look at a few charts typically to make up your mind, and then you implement the strategy in live markets. The quant approach, on the other hand, is of course, you again start off with the trading idea, which I spoke about. You encode it in a programming language. You test it on historical data. You test it on real market data, and then you deploy it in real. So you can see that there are some commonalities, but it's got a little more rigor attached to it with regard to what you do before you deploy something in the real markets, right? So let me again briefly talk about some of the benefits of this approach. It's trading minus emotions, which I spoke about earlier. It brings a certain scientific approach to the entire exercise of trading and investing. So you want to utilize the power of data. You want to utilize the power of cheap computing, which is all available literally at our fingertips, and help you make better investment decisions. You obviously avoid things like human errors and breaks that monkeys like us need to take, because computers can just keep working. You're able to scan many more markets and across many more instruments, all of that in parallel, and you're able to grab certain opportunities in speed because of the fact that so much of your workflow is automated, right? So these are some of the benefits. Let me also talk about, so I've spoken so much about the data aspect of this approach to trading, of algo or quant trading. So when I speak about data, really, I would say broadly speaking, there are 4 types of data, and what you use or what you prefer to use has a lot to do with who you are or your investment style or the kind of access you have to data, or in fact, even the background knowledge that you bring to the table. So for instance, we have a whole community of technical analysts and technical guys who keep trading using technical indicators. So you could perhaps, your primary source of data, or that you prefer to use while you adopt the quant style or the algo style, might be technical indicators like moving averages or RSI or Bollinger Bands or other such indicators that the technical analysts use. Or you could perhaps be the sort of guy who prefers to work with fundamental data. So that would be the accounting data that companies keep putting out, whether it's annual reports, which have their balance sheets and income statements, or quarterly reports, or for that matter, even macro data that keeps trickling in throughout the year, whether it's GDP numbers or inflation numbers or employment numbers and other such things. There are some people who prefer to work with pure market data, so that's the entire price, volume, and open interest, that kind of data. So when I say price, I'm referring to the open, the high, the low, the close, that kind of data. And work with that, use that as a primary data input, or you could use a combination of these. Now, the 4th type of data is an interesting one, and it's, I would say, one of the newer types of data that's used these days, which is what we call alternative data, which uses things like news feed. It uses data that comes from microblogs like Twitter. It also uses things like satellite image data or data that you have on, even for instance, the traffic that visits a particular website, or the kind of web searches that are being made, the kind of terms that are being searched, those kind of things. And let me talk a little bit more about the last type of data, because I think it's the newer form, which is I would say less seen or less used these days. It's increasing a lot, but nevertheless, it's part of I would say the new data sets that are getting utilized in order to come up with investment in the investment decision making process. So here, I'm sure some of us may have read this news about how Elon Musk and his tweets make a big difference when it comes to the value of bitcoins and other cryptocurrencies, or for that matter, how his tweets even impact the Tesla prices, right? So news or sentiment-based trading is essentially about incorporating the effect of this kind of news or this kind of I would say chatter that you see on social media, and try to incorporate that into your models and into your investment decision making process. Because basically news, whether it's news flow or whether it's tweets, all of these often update or modify the beliefs that market participants carry. So therefore, they act upon their beliefs, and that influences market prices. So you try to incorporate all of that into your decision-making process. Right? So you're trying to gauge the sentiment that is present or is prevalent for a certain asset or for a certain economy based on what people are tweeting or what news updates are streaming in. So whether the news is a little more positive or it seems to have a slightly negative sentiment associated with it. So essentially using all this kind of massive amount of data that gets created literally every single day. In fact, not that long ago, I even read that these in the time and age that we live in, on average, the 7.5 billion of us who are there on this planet, we produce nearly 2 MB of data per second. And this is essentially data that gets generated via our web surfing habits, or whether it's our mobile phone usage or the smart watches we wear, which are tracking the number of steps we take and how we sleep and so on. So the point I'm making is the amount of data that gets generated, which is from slightly unconventional sources, is also finding its way into the investment decision-making process. So that's what I mean by the alternative data that I spoke about. Right? Now the question is, fine, I spoke about a lot of different things, but how do I actually get there if I want to be part of this domain, right? So as I alluded to earlier, there are really three. I look at it as a part of three subdomains. So you need a little bit of programming, you need some knowledge on the financial markets, and you need a fair degree of comfort with math and stats. Now, this a combination of these things is what is going to help you. I would say immerse yourself in the community with regard to what people are writing, saying. Whether it's books, whether it's even understanding trading strategies or trader forums. So I often advise my students that our training and as we teach ourselves, we need to balance our own learnings across these three domains, and it varies based on who we are. So, for instance, if I am this guy who works for a tech company, chances are my programming would be fairly strong. I might be pretty decent also with math and stats, but my knowledge of financial markets might be quite good. So I would want to, at least to begin with, emphasize my training and my time much more on the financial markets and understanding them. On the other hand, let's say I am a traditional trader. So my comfort with financial markets is very high. I may have some degree of comfort with math and stats, but I may be a complete newbie when it comes to that. So in a case like that, my time, my effort, my focus should be much more on the programming and math and stats, right? So that sort of gives you some idea with regard to how we should spend our time and our efforts. So at the very end, something that I want to talk about is just to kind of cap it all, is that based on all the things I spoke to you, you might think that, hey, this domain and this area is way too complicated and I'm not sure I can handle it, but that's not true at all. It needn't be complicated. Yes, it can get pretty sophisticated, but it needn't be so. You can actually create pretty good, pretty profitable, and I would say pretty sustainable strategies with some very simple ideas. Even averages and standard deviations can get you some potentially profitable ideas. However, I don't want to sugarcoat it and make it seem like all it takes is a snap of a few fingers, or all it takes is maybe a week of effort. No, there are no shortcuts. I even not just me, my colleagues, and most of us, we still consider ourselves to be students of the domain. Every single day, we hope to know more than we knew the previous day. And really, there are no shortcuts with regard to acquiring knowledge and learning to apply it in the financial markets. So I want to make sure that you guys understand that there are no shortcuts here. And I really view our approach to being a part of the quant trading community or the domain as a marathon. So you need to pace yourself, right? We are not in a 100-meter dash where you need to go all out for like 10 seconds and hope to beat Usain Bolt or any 100-meter champion. We are in it for the long haul. So we, I would say, carefully look at what we know, what we need to know, and bit by bit, brick by brick, hour by hour, we try to upskill ourselves to the point where we can start using it. Right? I would encourage you guys to explore the free content that we have on the QuantInsti website. So we have 2 books that you can download, which are free of cost. There are multiple interactive courses on the Quantra platform. There's of course Blue Shift, which is also free. You can create your accounts there and try your hand there. There are a lot of demo strategies there. So you can play around with it, tweak it a little bit and see how it goes. And also we have a pretty buzzing blog, the QuantInsti blog, where you'll find articles on various aspects of the field. So you have things that talk about careers there. It even talks about books that you can read, or it points you to some good resources, educational resources for different facets of the field. You also have a lot of demo strategies there. You have past EPAT projects which have been put out there. So you have details on the results that people got when they tried out different strategies on different markets in different asset classes. So really, I would really encourage you to swim around in this vast ocean and just get a taste of how things go. So as far as today goes, I pretty much covered all the things I wanted to talk about. Tomorrow is really a continuation of what we did today. So today we spoke about quite a few different aspects. I would say from a distance. Tomorrow we are going to get closer, up close. So we are going to understand the quant research process a little more closely. We are going to try and develop a sample strategy and backtest this sample strategy in a research environment. So all of this is going to be done in Python by my friend and colleague Ashutosh, who will be doing it with you guys tomorrow. So that's pretty much it with regard to all the things I wanted to cover. And I'm happy to take questions, guys, now. So we throw it open for Q&A.
Brilliant. So I think it was a really interesting session, Vivek. I would say I personally got a lot to learn myself, right? So it was a refresher for me as well. So thanks so much for guiding us through as to what the domain looks like. And what I'll do is right now, there are some interesting questions in the Q&A, right? So I'll just bring them up one by one. So if you could just answer them, that'd be great for each and everyone out here.
Sure, pleasure.
Yeah. So the first question is by Deep. He asked, is it possible that 10 to 15 years down the line, when everyone is using the same algos or bots to trade, then there would be many buyers and almost no sellers, or vice versa. So because this happens, if this happens, then the trading would be difficult, as it is a zero sum game after all. So what are your thoughts on that, Vivek?
That's a great question. Deep, you said, right? So Deep, that's a
Yes.
fantastic question. So yes, actually, as things progress and as markets get more, so by and large, the financial markets are a very competitive space, right? All the time, market participants are trying to find that elusive alpha where you can get higher than risk-adjusted returns. So at one point in time, maybe 40, 50 years back, people who spend time on accounting data and really pour through it uh, would be able to find those sort of hidden gems and invest in them. People still do that even today, but it's much harder that way because many of these public stocks are scrutinized very closely. Similarly, at this point where we find ourselves, uh, so people who get into this style of investing quant would have, I would say, some degree of advantage because they would be some of the first movers in this domain. But as things move and as the way markets of that matter even evolution is, right, things will get more competitive and 10, 15, 20 years down the line, as you said, it's very possible that it's going to be harder to find those opportunities in the markets. However, I think I have a lot of belief in the human spirit in general. So people who adequately train themselves today and make sure that they've learned the best tricks of the trade for the day are also likely to be the ones who will keep an eye out for the newer tricks and the newer techniques that come up as time goes by. So I think it's more a mindset thing where you need to get into a mindset where you want to be as close to the state of the art techniques that are used so that when those techniques become slightly outdated, you still try and keep pace with the newer techniques that come. So yeah, I think it's like I said, it's more a mindset.
Understood that. Great. So I hope that answers your query, Deep. So I'll come up with the next question by Yash. He asks, can an individual or a retail investor use algo trading because the technical skills that are required will be more than what a good coder would already know? Is that correct?
Again, very good question. So I think what is happening since the last several years is that the newer tools that we get are trying to simplify some of the more, I would say, irksome or the more painful parts of creating a work. So even something like a blue shift tries to, you know, take care of many of the slightly more painful aspects of trading. So for instance, when Jay will demonstrate it on Saturday, you'll see that a tool like Blue Shift has certain benefits compared to what Ashutosh will show you tomorrow. So essentially, with the passage of time, newer tools that come up are trying to do away with some of the harder aspects of automating your trade end to end. So yes, it is a little difficult, but I would say what in 2021 to automate your trades is much easier than it was, I would say, 2 years back. And so, for instance, even BlueShift has this feature called visual coding. So visual coding just literally needs you to drag and drop certain images which set up certain conditionalities. That would be a very attractive feature for people who don't program or who are not so comfortable with programming. So I think it's so there is a certain amount, there is an element of a learning curve, but the curve is getting a little gentler with the passage of time.
Understood that. So yeah, I think Yash, this answers your query. I have next one by Ravi Kumar. He asks, is it possible to strategize on socio-economic and seasonal events? I believe you covered this in the slide. So even if you just could give a short description on this.
Sure, sure. So I think if you spoke about social media data, I believe what he was referring to was something to do with social media. So if you-
Socio, socio-economic and seasonal events. So he's actually talking about the all sorts of different events happening around.
Okay, okay. So I think
Yeah.
based on what I understand, what he's asking, I think socio-economic events probably fall in either the fundamental part. So economic events like GDP inflation comes under this fundamental, and social events, I would probably categorize it under news. So something to do with, let's say, the news that keeps trickling in about the pandemic, right? The vaccination outreach and how it's what's happening and where the numbers are going up and down. So a lot of that comes from alternative data like news or what you see on social media. So in any case, those things do get incorporated these days when it comes to data inputs. So it's already a reality today using socioeconomic inputs.
Perfect. Great. So the next one is by Liaquat. He asked, for a beginner, is it fine to do day trading or start with investment for long period? What should be the approach?
Liaquat, hopefully you are not going to be disappointed, but the simple answer to your question is depends, because it depends. So it really depends on what the goals of the investor are, what is the amount of capital you're using, and really. So to put it very simply, right? Let's say I set aside 5% of my monthly income for extremely high risk investments, right? In a case like that, I might just go for intraday and with very high leverage, because I'm not too bothered, because it's only say 5% of my monthly income. I'm willing to lose nearly all that money. However, if the investment is for my own retirement, when I'm out of the labor market, then I'm going to have a very different mindset when I invest. So would I use a day trading approach? Probably not. So yeah, that's what I would say.
Understood that. Now, the next one is by Ashwin. He asked, can we do option writing against IV and OI?
So Ashwin, I'm going to sidestep that question because it gets too technical with regard to the scope of what we're talking about. But I would welcome you to maybe write into us, or and somebody can take a look at your question and answer it. Just because of the scope of what we are talking about today, I'm probably going to not answer that question. Yes, apologies that I cannot answer it, but I want to make sure that the scope of our session is fine.
For sure, no problems, Vivek. So what I'll do is I'll ask one of the team members to reach out to Ashwin, and they could write in a response to this question. So I'll take up the next, right? So basically, since there are a lot of beginners in this field, there's a very good question from Aditya, which actually highlights a very, very basic question, which is actually good. He asks, what is the difference between Quant's, Algo, and HFT?
Okay, so I touched a little bit upon it at the beginning, but let me try and explain.
Just a
So
summary.
yeah, sure. So HFT, by its very name, is high frequency trading. So this is the sort of trades where people are holding positions for fractions of seconds. This is almost never practiced by retail investors. These are almost always institutional investors. It would be like the iRage Capitals of the world, the JP Morgans of the world, and the Virtus of the world, who have the kind of infrastructure and the capital to invest in this format, where you, like I said, your holding periods last for fractions of seconds. That is high frequency trading. Again, because of the very reason that you're only buying and holding for fractions of seconds, there's no human who's actually doing it. It's computers that are launching the buys and the sells. I think what are the other two? Algo and Quant, is it?
Algo, Quant, and HFT.
Sure. Okay. Quant trading is a style where you're trying to utilize statistical models in order to come up with rules to trade. I would say algo trading is a subset of quantitative strategies. And algo trading, again, like I mentioned at the very beginning, right? These terms are used quite loosely, and literally regulators have different definitions. But one way to look at algo trading is it is a subset of quant trading where the focus is much more on specifically the execution of the orders, not so much on how you arrive at the point of execution. So let's say I arrived at a point where I need to, so I'm an institution and I need to buy uh, 10,000 shares of TCS today, right? Uh, the algo trading in that specific definition would mean what is the best way for me to place the order for those 10,000 shares such that I can get a good price on it. Should I just buy 10,000 outright in the market, or would that impact the price too much? So should I divide it into smaller units of say 100 shares and execute it 100 times through the day, or is there any other better way to do it? So that becomes like a subset of quantity. So yeah, that's what I was saying.
All right, great. Thank you so much, Vivek, for that. I have one from Ajit. He asks, do we really need to do programming or use the tools which are available in the market? Uh, are they sufficient enough as long as I know my strategy well? And can I define each and every minute steps?
Okay, so I think if so, again, it depends on how deep you want to delve into the domain. If you are intending to either work in the domain or you want to be a more active manager of your own money, right? I think a degree of comfort with programming is necessary. I don't expect us to be, ninja level programmers who sit and program websites like a QuantInsti, right? You have developers who do that, who are much better at that. But we should know enough to be able to at least read or make sense of somebody else's program. And that I think will, so even if you don't write any programs yourself, if you're able to read someone else's program and make and understand it pretty well, not just vaguely, I think it will help you improve your own, I would say, investment approach also. So yeah, that's what I would say.
All right, so we'll take the last couple of questions, Vivek, since we have time constraints.
Sure.
So now what we could perhaps do is for the rest of the questions, our team members would be reaching out to you. And anyway, some more detailed concepts would be covered in day 2 and day 3. So there is a good chance that the questions which you have asked today, they would be covered in day 2 and day 3. So we'll just take up the last couple of questions. I've seen this question coming up a lot. What is the minimum capital requirement for a retail investor to start algo trading? This is by Pranav.
Actually, I think probably somebody can guide me to us because I'm not sure. These things change a little bit here and there, and different brokers also have different styles of accounts. So I'm not sure there's a straightforward answer to that question because it again depends on the different styles of subscriptions. So let's say you decide to trade every day or nearly every day, or maybe 5 to 10 times a week. There's a certain type of account you will take. If you plan to trade multiple times a single day, there's a different style of account. So it's really similar to the kind of subscriptions we take on, let's say, even on Netflix, right?
Right.
Based on how many people are going to view and what they're going to view and stuff.
Completely makes sense. So it depends from broker to broker. Is that what you are saying, Vivek?
Broker to broker, and how you anticipate your own investment behavior to be. So are you the sort of person who expects that you'll log in every day and you'll probably trade, or are you going to log in like once a week when you have time, or how often are you going to keep buying and selling stocks? So if I expect, so again, this is several years ago. Before I got into this space, when I was a discretionary trader, I had a account with a broker with a broker in India. Subscription I had taken was there was a limit on the number of trades I can make in a financial year. So if I remember correctly, I had a subscription where I could make about 400 trades in a financial year. So that works out to just about one trade a day, right? So there were people who would want to take an account where you can make 2,000 trades in a financial year. This is, of course, many years ago. The way it operates in the algo domain is slightly different, but should give you some sense of what I'm trying to tell you.
Perfect. I think he must have got his answer. So thanks so much, Vivek. And the last question is by Sri Rama. Um, does algo or quant trading only deal with data sets from a stream of data, or do people also use image processing of the charts of stocks and indices?
Actually, it's a combination, Sriram. You can have pure primary data, or you can also use data that gets derived from the primary data. So a lot of times, some of the fundamental info that we use would even be things like price to earnings ratio, or many such ratios that get generated while people are working, say, with fundamental data. So it's an interesting question. So it can be, like I said, a combination of primary data that comes from directly from the source, or that gets generated directly from the primary. So we often use things like the betas associated with different stocks. Now that has been computed based on market data, but we just take the betas as a given, whether we get it from whichever data vendor that we want, whether it's a Bloomberg or someone else. Yep, I think.
All right.
Yep,
I think that answers the question, Vivek. So I think I believe we are pretty much done for the day, right? And I'm very certain that a lot of people, or rather I would say maximum amount of people, have found this session really insightful. I personally found it that way, right? And I'm really excited for day 2 as well, because since we are going to cover how to work with data and formulating and backtesting a trading strategy. So it's going to be a really interesting session tomorrow as well. So I'll be looking forward to that. Once again, thank you so much, Vivek. It was a great time which I had, and I'm sure all the audiences out here have had a great time too. So thank you so much once again.
Yep, my pleasure. And I hope you guys had a good session and it was informative. And my very best wishes to all of you. We hope to see you again tomorrow and day after tomorrow. And may you all succeed in your quest for that elusive alpha in our investments. Thank you.
Great. Thank you so much, Vivek. Thank you so much, everyone, for being such a wonderful audience. We'll be seeing you tomorrow once again. Cheers. Bye-bye.